Bitcoin, the first decentralized cryptocurrency, was introduced in 2009 by an unknown individual or group under the pseudonym Satoshi Nakamoto. Since then, Bitcoin has gained popularity and has disrupted traditional financial systems, particularly the banking industry. Bitcoin and other cryptocurrencies offer a decentralized and transparent alternative to traditional banking systems. This paper explores Bitcoin's impact on the traditional banking system. Overview of traditional banking system. The traditional banking system is a centralized system that has been in existence for centuries. Banks have the authority to create and control the money supply, and they charge fees for their services. Banks also act as intermediaries between individuals, businesses, and governments in the movement of funds. The traditional banking system has its limitations. The system is prone to fraud, money laundering, and other criminal activities. Moreover, banks have been known to charge high fees, restrict access to financial services, and discriminate against certain groups of people. Impact of Bitcoin on the traditional banking system. Bitcoin's impact on the traditional banking system is far-reaching. The decentralized nature of Bitcoin means that it is not controlled by any government or central authority. This makes it difficult for governments and financial institutions to regulate Bitcoin transactions. Bitcoin transactions are also transparent, as every transaction is recorded on a public ledger known as the blockchain. The transparency and decentralization of Bitcoin have led to increased trust in the currency, particularly among those who are skeptical of traditional banking systems. Bitcoin transactions are faster and cheaper than traditional banking transactions, and users have greater control over their funds. Moreover, Bitcoin allows for greater financial inclusion, as it can be used by anyone with an internet connection. However, Bitcoin's impact on the traditional banking system is not entirely positive. Banks are losing control of the money supply, and some have expressed concern about the potential for Bitcoin to be used for illegal activities. Moreover, Bitcoin's volatility makes it a risky investment, and many financial institutions have been hesitant to invest in or offer Bitcoin-related services. Responses of the banking industry to Bitcoin. The banking industry has responded to Bitcoin in different ways. Some banks have embraced Bitcoin and other cryptocurrencies, recognizing their potential as a disruptive force in the financial industry. Others have been more cautious, waiting to see how Bitcoin develops before committing to any particular strategy. One response of the banking industry to Bitcoin has been to develop their own digital currencies. JP Morgan Chase, for example, has developed its own digital currency, JPM Coin, which is used to settle transactions between clients of the bank. The development of digital currencies by traditional banks can be seen as an attempt to compete with Bitcoin and other cryptocurrencies. Another response of the banking industry to Bitcoin has been to invest in blockchain technology. Blockchain is the underlying technology that powers Bitcoin and other cryptocurrencies. Banks have recognized the potential of blockchain technology to improve the efficiency and transparency of their operations. Blockchain can also be used to create smart contracts, which are self-executing contracts with the terms of the agreement between buyer and seller being directly written into lines of code. Conclusion: Bitcoin has disrupted the traditional banking system by offering a decentralized and transparent alternative to centralized banking systems. Bitcoin's impact on the traditional banking system is far-reaching, with some banks embracing the technology and others being cautious. The development of digital currencies and blockchain technology by traditional banks can be seen as an attempt to compete with Bitcoin and other cryptocurrencies. As Bitcoin and other cryptocurrencies continue to gain popularity, the banking industry will need to adapt to remain relevant in a rapidly changing financial landscape.